Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the IWM. That is an ETF that tracks the Russell 2000 index. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsay, I have a chart of the S&P 500 index up, and there really hasn't been too much to discuss. Now, I know that a few weeks back in your weekly that you usually put out, we talked a little bit about what's going on with the S&P 500 index and the 50-day moving average. We've really meandered to new highs for quite some time. And I do want to kind of highlight a little bit of a breakout that we're kind of having in the SPX, even though it's not a massive breakout because we really haven't had any strong moves to the upside, but we do keep setting new highs. But if I look all the way back at this 50-day moving average, we do got them lined up correctly, if you will. We got the 200-day, then the 50, then the 20. That's what you want to see in a bull market. But there's only been one time, we got to go all the way back to November, where we spent more than 2 days below the actual 50-day moving average. So that's interesting little point. We talked a little bit about that on the weekly that I know you put out to all of our clients inside our Ally community. But if I look up at this little trend line that I've drawn to the upside, we see that we're kind of getting a little bit of a breakout. And I'm simply just taking the highest point, and I see we got one touch here, one touch there, we got 3 or 4 touches. And the more times we usually touch a resistance point to the upside, the better the chance is for it to really break out. And then on the downside, now we could draw a channel here, but I'm going to kind of just highlight a few of these points is that we're kind of, oops, I didn't quite get that right. Let me try it one more time. We're kind of have a wedge pattern. So every time that we go down to the lower end of the channel, we're basically having higher lows, which eventually usually is a sign that we may springboard to the upside. So there are a couple interesting things. It's not as interesting as what we're going to talk about today, which is the IWM chart. Talk a little bit about what's going on with the small caps. The chart is looking a little bit more interesting than the S&P 500 index. But with that said, what's going on in the markets this week, Lindsay?
Well, I think I would just tag along. Like Brian mentioned, I put a weekly viewpoint out every week on Fridays, and you can find it at the community hub, the Ally community hub, which is at the ally.com/do-it-right website. Brian also puts out some commentary there occasionally and other thought leaders. So check it out. We did talk about this line in the sand, which is the 50-day moving average. Like Brian said, this year we've touched it 4 times, only closed below it 4 times before rebounding very quickly the day after we close. Usually the market has been up on average 1.4% this year. And within 5 days, we've reached new highs. So this is there's a significant amount of momentum in the market right now here. And that 50-day moving average really has been a stronghold in what is usually a weak month for the market. Well, Brian, you and I talk about seasonality all the time. September, we're going into even weaker month. Yet the market is, hitting new all-time highs. Today, you see a little bit of mixed action in the marketplace. I think really the market's waiting to see what happens with the jobs report on Friday. That's going to be a key indicator for the market. We've seen COVID cases rise over the last month. We've also, are eagerly awaiting and anticipating when the Fed's going to begin to taper their bond purchasing programs. We heard last week from Fed Chair Powell that it's likely to happen either in December or January. And that'll depend a lot on what the jobs report looks like over the next couple months, because the Fed has really pinned themselves to their full employment mandate over their inflationary keeping prices stable mandate. And so to the extent that the jobs market can remain hot, that'll set them up nicely to begin tapering. The thing about it is, though, is this Friday's job report, economists are anticipating that about 750,000 new jobs were added in the month of August, which is a blockbuster number, a really great number. And they're saying that unemployment could have potentially fallen to 5.2% from 5.4%. So that's a pretty big improvement, and it would set the Fed up to begin, their tapering program later this year. Now, however, we could see a miss like we did with consumer confidence this morning. Huge miss there. We saw consumer confidence drop to 113, which is still in expansionary territory, but it's the biggest drop that we've seen in quite some time. So that kind of, I think, is the market's trying to read into that. What does that mean? The consumer is clearly becoming more cautious when you take today's confidence number tied in with the sentiment number that we got for August. The consumer is being more cautious. But when I dig into the report, the confidence numbers that we got today, there's an indicator, Brian, in there that talks about how people feel about the job market, the labor market. And they ask people, do you expect jobs to become more plentiful in the next 6 months, or do you think that they're going to be harder to get? And so both indicators, the plentiful indicator declined, the harder to get indicator increased, so both looking a little less optimistic. But when you put the plentiful versus the harder to get number, you divide those, that ratio, yes, it declined month over month, but it still remains at really high levels, actually historically high levels for the index. So the job market still is pretty hot. And oh, by the way, even though consumers are losing overall confidence or it's being reduced, they're still saying they're planning to go on a big vacation in the next 6 months. They're still looking forward to that. So I think there's some emotions at play here as COVID cases pick up. People are realizing that we're not back to the old normal, pre-COVID normal. So we're still in a wait and see mode, not exactly sure how that's going to impact spending. So a strong jobs report could potentially help offset that. And the other indicator, Brian, that I'm looking at in the market before we get to the VIX, sorry, I know I'm covering a lot here today, but the other indicator that I am keeping an eye on is the 10-year yield. We've seen the 10-year actually move up in the month of August. In July, we got down to 117 on the 10-year, which is pretty low by historical standards. We've crept up 10 basis points. I don't know exactly where it is right now. And what you usually have seen, that bottoming in July, that was a months long bottoming process for the 10-year yield. I don't know if you probably can't pull a chart of it up, but the 10-year yield.
Pull it up. Let's do it. Here we are. Okay. So here's the SIBO 10-year yield.
Okay. All right. You got it up there. Pull it onto the screen. So you see, if you zoom out a little bit more, you can see that the 10-year yield, it's been in a strong decline since March there. And more recently has been popping up. And usually what that means, the 10-year yield can oftentimes preclude or come before a turn up in economic data. And economic data has been missing for several months. Just like I said, the confidence numbers, sentiment numbers that we've seen more recently. Today, there was the Chicago PMI was a little weaker than expected. So potentially we can get a weaker than expected jobs report in August. But based on the move we're seeing in the 10-year, it might be indicating that economic data is turning positive, which bodes well for the stock play of the day today, the small cap IWM, which we're going to get to in a minute. But I also, Brian, we always like to talk about the VIX. I mentioned seasonality. In September, stocks historically have gone down, but the VIX has also declined slightly on a historical basis in the month of September, but also in the month of September, you usually see the VIX spike higher, even though stocks are weaker. So I don't know. It's a lot to consider. I think that you've been keeping a close eye on those out month VIX. So not the current VIX that we look at the couple months out. What are you seeing?
Yeah, so let's go to my VIX watch list that I have set up here inside the Ally Invest trading platform. We do see the VIX today. It has came off a little bit, but I think that can be expected because of we got some major news that happened last week with the Fed meeting in Jackson Hole and Powell's comments. A lot of times that will drive the VIX up a little bit, and we did see that last week. We had an up market and we had an increased VIX a little bit, which is not very common, but but it does happen around Fed meetings. And then now if we look out to the September and October, it is interesting to note that with that September future, we are down below the 20 level, which as you mentioned, a lot of times September, more recently, it hasn't quite played out that way, but over time, usually September is not one of the better months in the marketplace overall. And so to look at the September futures contract and see that below 20, that's a little bit of a sign of confidence. We go out to the October contract. We're back up above that 20 level again. The October contract right now is trading at 2103. And I'm going to highlight the November contract. We're up around 22. So I think as far as the marketplace is concerned, if we go out further in time when we eventually see these futures contracts trading down below the 20 level, well, then there's going to be obviously a lot more confidence in the marketplace and in these new highs that we are setting. So kind of surprising to me to see the September contract down around that 18 level. And it is interesting because I always talk about September and October being extremely volatile months in the marketplace. But a lot of times the VIX doesn't necessarily reflect that overall. And that's really been the case as we see the chart of the S&P 500 index. The actual volatility is kind of boring overall, but we still see that VIX trading above the 15 level. But it's really hard for it to breach the 20 level recently, which was the magic number before the pandemic. It took us forever to get below that level overall. Okay, so before I pass it back to you, we're going to talk about small caps and IWM. I got a few things that I want to highlight on this chart here. Once again, when we look at small caps and the moving averages, we've got the 200-day moving average. So we're a little bit overextended on the S&P 500 index. We're about 500 points away from the 200-day moving average. NASDAQ is fairly similar, but in the Russell, we don't, that's not the case. And we've definitely been trading within a channel. I've drawn a couple of horizontal lines on this chart, but this going all the way back, and I mentioned this, and I'm not sure if it was on Stock Play of the Day or in my podcast, but if we just draw from the very bottom, a very strong channel going all the way back to March of 2020, quite a few touches. We actually just hung out at that line in the middle of the channel. And we finally broken out of that. If we look at a Fibonacci number, and I think I do have the Fibonacci's up and running here. Let me just grab this real quick. And I'll just draw Fibonacci's. I don't want too much in there. We see now, I want you to focus on where that area is, where that trend line, that blue trend line and everything is that I drew right over here in this area. And you see that there's just a lot of activity as far as the chart is concerned. You could even come back, that's right at a 61.8 retracement. You see where the 50% retracement is where there's been a lot of volume overall as far as Fibonacci's are concerned. So there's just many different things that are happening right around this area in the Russell 2000 index. So the markets would do very well if we could get back to the higher end of the channel. And that's what we're going to look at today. It's going to be more of a speculative trade based off of the fact that hopefully we hold this level and we can break to the upside. It would be good for the markets if the small caps could start leading again, like they did when we came out of, when we're not necessarily out of the pandemic, but when we started to get back to more a normalcy. The Russell 2000 index was leading the way there. So in this instance, we're going to just look at doing a shorter term speculative trade, hoping that we hold this line here and can start making a move to the upside. And then I would be much more bullish overall if we could. Now, once again, not meant to be a recommendation overall, but if we could break to new highs in the S&P 500 or in the Russell 2000 index, that would be a very good sign for the marketplace overall. And a lot of this has been sparked by the Fed comments from last week, just in general. So I got a little long-winded there, Lindsay. What are some of the comments that you have on the small caps and what's going on in the marketplace?
Yeah, no worries. You had some good analysis on the move and the chart there, which we always appreciate. We're no technicians, but we do appreciate what technicians do. That's for certain. Before I get into the fundamental story on small caps, I just want to remind all of our viewers, first of all, thank you for being here. We love having you. But we're also going to take live questions at the end of the show. So in the YouTube chat box on the right, Feel free to type out any questions on your mind. I see we've already got one question in there. We'd love to hear from all of you. Even feel free to put a little waving hand to just let us know you're there. We'd love to see that too. But let's dig back into what we're here to talk about today. The IWM, the small cap index. Brian has went through the what we've been seeing in the chart more recently. If I look at that chart too, I agree with Brian. We've been trading in this channel for about 8 long months. If you're looking at that chart again, it looks, we haven't done a lot. It doesn't look like we've done a lot because it's quite a wide channel there. But if you look at between June and mid-August, the index actually declined, the IWM, I should say, it declined 9 percentage points. So almost into correction territory, which is a 10% decline, somewhere between a 10 and 20% decline. Didn't quite get there, but we have been moving higher on the back of some of what the Fed said, encouraged by the trends we're seeing in the economy and expectations for the future, and feeling good enough to, as I mentioned earlier, really take the gas pedal at least off of some of the monetary stimulus that they've got they're putting into the economy, the liquidity that they're putting into the economy, which is a sign that they think the economy is strong enough and we don't need it. So that bodes well for the small caps. It bodes well for the reopening story, which is what the small caps are all about, right? So like Brian said, the technicals look like they're getting in line. Also, to further that point, I will say Friday was a day that we saw solid breadth, not only in the marketplace, but especially within the small cap. So on an 18-to-1 basis, you saw 18-to-1 stocks advancing, advancing is positive. So 18-to-1 stocks advancing versus declining, which is a huge positive. The move we've seen up the channel that we're in, just the technical indicators that Brian mentioned show that the IWM could be positioning itself for a breakout. We saw a lot of people pile into the small caps earlier this year. You see that big run up on the chart, which benefited from that. And then in the summer, they kind of got tired, moved out of the IWM, which could be a good thing if you're thinking about it from a contrarian's point of view. Let everyone get out and then make it time to get back in. So that is where we could potentially be. I think also too, what we saw in the run up from the end of last year into the beginning of this year really was the market anticipating that the reopening story following another outbreak of COVID was about to make way, and it certainly did. So you saw the stock market anticipate that. That's what the stock market does. It's always a forward-looking instrument, and the IWM is especially a forward-looking instrument in the case of the reopening play. And the fact that it's starting to turn around here, and coupled with some of the nuances that I mentioned with the 10-year and economic data in general potentially turning positive into the end of the year, that could be a good setup for the reopening trade, the small cap trade. So it's something that we're going to really keep our eye on. The market really has been good at anticipating swings in COVID. And while it doesn't feel great right now, Delta cases continue to surge, hospitalizations are up. We do know that we're seeing declines in some of the states that saw the Delta variant increase more rapidly, like Florida and Texas. Keep an eye on that trend because once the reopening does happen again, these guys are going to be the key beneficiaries, as well as some of the other sectors like financials, industrials, materials. And we've seen that happen more recently too. We've seen those sectors start to perk up too. So that's why we decided to take a look at this, especially in the near term, get in on potentially on the earlier side in a move in a sector like this. So that's the fundamental story, Brian. What's the trade you're looking at?
All right. Well, I'm going to jump right to the options playbook, and I'm going to talk about the shorter term trade and how I might look or might think about jumping in on the IWM. Now, as always, this is not meant to be a recommendation. We're just trying to learn here on the stock play of the day. And specifically what we're trying to do is match up strategies inside the options playbook or optionsplaybook.com website with the market conditions right now. And we still have elevated volatility. Now, obviously, it's not as elevated as it once was, but we're still trading in the S&P 500 index, the VIX volatility above that 15 level, right around 16 or so. And we see the longer term option contracts actually trading 18, 19, 20, all the way up to the 22, going all the way out to December. So with that said, there's some volatility in these underlying indexes. So we're going to look at a long call spread. What does this mean? This means that as opposed to just buying the call outright in the IWM and having a bunch of time premium in that option contract, we're going to go up and target a range. And we kind of see there's definitely a defined channel in IWM. So we can target an upside price, and then we're going to sell a call against it, saying that if we sell that call, we'll bring in some time premium right now, but we're going to cap our upside, and we're going to have limited and known upside and also limited and known downside. We're going to reduce our risk a little bit. So that's the long call spread. We're going to go out only a couple of weeks in time. We're going to see basically if we can hold the line on everything that we saw on that chart. There's just a whole bunch of stuff that's going on right now. So it'd be very positive if the IWM could end up closing at a higher price than it is right now. So if we could stay above all that chart wise, that would be a good thing. So let's look at the Ally Invest option chains. And the first question is here, what is the best way to get the strike price and strike data? Well, inside the Ally Invest website, it actually is the option chains. And that's the first question we see in the chat box. I already have IWM put in. We see here's the last trade in IWM. It's up today. It's an ETF. It's not an index, right? So that means that you can buy shares of it. Indexes you can't buy shares of overall. So that's part of the reason why we picked the IWM. Just in general, it's a lower value than the actual Russell 2000 index. And if I scroll down, we have a plethora of different expiration dates. We're going to concentrate on the 17-day. As I mentioned, it's a little bit more speculative trade for the stock play of the day, mainly because we have such a short time frame overall. So we're going to go a little bit in the money. We're going to buy the 224 strike call. And we highlight that this is the call on the left-hand side of your screen. And we just click the little buy button over here, and that actually makes it a buy as far as our strategy is concerned. Well, now we got to sell an option contract. So we're going to go up and I'm going to quickly run to the chart, right? In this area, we're looking at 234 is a little bit of resistance, going to be kind of hard to get through that area. So I'm going to target just below that. And that's the main reason why I'm going to select the 230 strike call. I can bring in a decent amount of premiums, trading 174 by 175. And one thing that is great about this ETF is that you have very liquid markets, penny wide on a lot of these option trades, which always helps out on the bottom line. So once we go over here and we click sell, as far as our strategy is concerned, then we scroll down and we have our option strategy workbench. And we would be entering this all as one trade. We'd be buying to open the 224 strike call and selling to open the 230 strike call and trying to get a net debit to the account at the midpoint. Usually we talk about midpoint. Midpoint fills aren't always guaranteed, but that's kind of the focal point. We say that is the true price of this spread. And I'm going to put it in the right rail, and that'll make it the official paper trade for this week once we throw it over here in the right rail. Buying to open the September 17th, 224 strike call, selling to open that same expiration, 230 strike call. We're going to try to get this done for a net debit of $3.16, which is the midpoint right now. That would be $360 plus commission if we did that. And overall, we're looking at doing a 6-point wide spread. So it's almost a 50-50 play here in that if we pay $3.16, that's the maximum that we can receive for it, or that's the maximum we can lose. On the upside, it's the width of the spread, which is 6 points wide. That's the maximum that we can gain. So in this instance, if we do get the breakout, well, we got potential to make just under $3. And if we don't get the breakout, it breaks out to the downside, the maximum we can lose is the net debit that we paid for that trade. All right, so put your questions in the chat box. We'll see if we can answer them. As I finish up, I'm going to look at our profit and loss calculator right here. And I want to highlight that This is at expiration inside the options playbook. The playbook is all about, the graphics are all about expiration. It's not an interactive website. On the Ally Invest live option chains, we are interactive. So I'm going to zoom in a little bit here. And I'm going to kind of show you why we want to do a little bit of a shorter term option contract in that. Here's where the underlying stock is at. This is what the spread looks like as of today. The dotted line is at expiration. As expiration approaches, you will see if you are correct on your forecast, eventually the line will start morphing towards that dotted line. So let's go all the way down to 2 days remaining to expiration, and we'll graph it, and you can see that movement of that line right now. But also, if the market goes down, that time value actually saves you on the downside a little bit too. So ideally, if you're going to be correct, you want to be correct closer to the expiration date. If you're going to be incorrect on your forecast, you want it to go against you sooner rather than later. And that's the moral to the story of long call spreads. All right, so we got a few minutes left here. Lindsay, do we have any questions in the chat box that we want to address?
Yes, we do. We were getting some good participation. I appreciate the smiles and the waves. Derek Williams asked, do you need to first buy the underlying index to be able to sell a call?
All right. Well, this is an ETF. In this situation, we do not. The long call spread, I'm going to jump back over to the options playbook. By buying the strike, buying a call that's below the marketplace, you're saying I have the ability to buy this underlying at that strike, allows me to sell a strike price that's above that current strike, saying that I'll take on the obligation for you to call away that underlying stock. So as long as in our instance here, we are buying the option with the lower strike call price, the 224 strike call, then this would be considered a covered position, and our maximum risk would just be that net debit paid. Now, in an index, you can't buy the index, right? You have to buy something that is representative of it, and that's where ETFs come in, i.e. in the S&P 500 index, the ETF that tracks it, or the more popular one is the SPY, the SPY, the spiders.
Okay, quickly, we have a couple questions running out of time though. Can we talk about managing the trade and stop orders that we can put in at the time of entering the trade?
All right. Well, as far as options are concerned on spread trades, we don't have the ability to put a stop order in on the downside. Now, one of the things that we look at here is that we have just as much risk to the downside as to the upside. So a way that I would normally approach this is if I paid $3, I might watch it and say to myself, if I lose half of that, I'm going to get out on the downside, but I'm going to try to gain as much as I can on the upside. So limit my loss to the downside. If I lose half of my investment, which is $316, I would close it and get out. That's one way to approach it. And then hopefully I can get to maximum if I'm correct on my forecast on the upside. But I do like spreads because you automatically have that, what's the word that I want to say? You automatically have the max loss figured out in that scenario, and you can manage it with the spread. You can say, okay, I'm going to pay $2 and give myself $8 worth of upside. I can totally manage that spread and watch my risk by just choosing the strike prices that I want to buy and sell.
All right, Brian, I think that's all we have time for. I'm sorry that we couldn't get to these other questions. Tune in though on Friday because Brian is going to review this trade and make any suggested tweaks to it that make sense depending on where the stock went over the next couple of days, right, Brian?
Yeah, we'll definitely watch it. So tune in this Friday at noon Eastern time for the stock play of the day overtime. You want to click subscribe and ring the bell to make sure you get all the alerts for all of the stock plays of the day. And we'll see you this Friday. Thanks for coming, everyone.